Hello, and thanks for joining us for Gainline's 2026 mid-year market update. I'm Casey Wesson, a financial advisor at Gainline Financial Partners in Boulder, Colorado. Here with me today is one of our partners, Charlie Barkmeier. Hey, Charlie.
Hey, Casey. Thanks. Great to be here today. There's a lot of movement in the markets and with headlines throughout the first half of the year. So looking forward to walking through a lot of what we saw driving that and what it means for how we're thinking about the rest of 2026.
Awesome. I can't wait to get into it. So, like you said, 2026 has been a very busy year so far, and I can't believe it, but we are only halfway through. We've had multiple geopolitical conflicts, a shifting inflation picture, constant AI headlines, and yet markets have stayed very strong and resilient throughout all of this. The S&P actually finished up the first half of the year up nearly 10%, which is already above its long-term average annual return. What do you think is driving that?
Yeah, and I think resilience is a really great word to use to describe it there. And that resilience and that market growth we're seeing is backed by real earnings, not just optimism. As we can see on the chart here, the S&P 500 earnings grew by nearly 30% in the first quarter versus the same quarter a year ago. And analyst estimates are in the 23 to even as high as 29% range for the second quarter. And we should see those numbers coming out of the course of the next month or so. And so you can see here the market or the index growth is backed up by real earnings and real profitability growth. And that's really encouraging to us to see as a sign of a healthy market that we're seeing growth backed up by real growth. And it's also encouraging to us that the underlying economy is in very solid shape based on major economic indicators. So we're looking at things like GDP, which is growing above trend. Unemployment is at a relatively healthy level of about 4.2% right now. Consumer spending is holding up pretty well. So even though we've seen some inflation, which we'll talk about here in a little bit, consumers are still spending, and household net worths are actually at record levels across the US. So these are all really good indicators and fundamentals that back up a strong market. And these show us that this is a market that is not held up by just optimism. There's real depth and breadth to the growth that we're seeing.
That is super positive to hear. And I loved what you said that we've got growth backed by growth. Since I know that's been a concern with what I'm going to now bring us to, which is AI and the AI trade and making sure that that growth really is there and fueling earnings. So there's an enormous amount of money that is flowing into the AI trade. Is that what is powering these earnings? And do you think that the market is getting too expensive?
Yeah, and so as you mentioned, AI infrastructure spending right now is massive. Some of the largest companies like the Magnificent Seven, which is the biggest tech names, are spending a lot on data center build-outs, computing power, improving their networks, the models themselves. These are all major drivers of this really strong profit growth we're seeing because they're investing, by some estimates, between $750 billion and $1 trillion this year, and that's expected to exceed $1 trillion in 2027, into these things that are driving profits and driving revenue at companies all across the economy. For context here, the current infrastructure investment spending is comparable as a share of GDP to the electrification of the American economy. And then if we look at kind of a higher end estimate, current investment levels would have to roughly double to match the levels as a percent of GDP of the railroad build out at its peak in the 1870s to 1880s. So both of those were massive infrastructure investments that looked very expensive in their time, but laid the foundation for transformative change to the economy. I think that's what a lot of people are seeing with AI. And we're already seeing increased productivity and a lot of optimism around that. And that's expanding growth beyond just tech stocks. So we have our chip makers, but also data center builders, power utility companies, financial firms financing the activity, all are benefiting. We see small cap companies really doing well versus the rest of the economy for the first time in a while. They're up about 22% so far this year. And international markets are also among the stronger performers. So it's encouraging to us to see the market growth expand beyond just some of the really big tech names, which was certainly the story through COVID and even into 2023.
Yeah, super exciting stuff, honestly, to really start to see the breadth in that S&P 500 growth. But do you think there's anything that we should be concerned about?
Yeah, I think there's always things to be concerned about in the market. And when I see right now certain parts and sectors where sentiment's getting stretched, so where we're kind of saying, hey, there might be a little bit too much optimism here, or we're banking on continued really strong growth to meet these valuations, that's where we can start to see something like a meaningful slowdown in AI spending or profit growth coming in a lot lower than expectations ripple through markets pretty quickly. So while the long-term picture, I think, continues to be really strong, we need to be prepared for volatility. And even though there's underlying very strong demand for compute power, energy, and infrastructure, this is not a risk-free environment. And I think it's important for us to expect a rocky road, even if we feel really optimistic about maybe the next 5 to 10 years in the market.
Well, speaking of risk, I want to take us over to the inflation picture because I know that all of us have been feeling the inflation, especially lately. And headline inflation climbed to roughly 4% earlier this year. And I believe right now is at about 4.17%. What was behind that?
Yeah, so the biggest thing that drove that was really the energy price spike driven by the US-Iran conflict. A lot of folks really felt that heavily at the gas pump. We saw, in Colorado, gas prices in the low to mid $4 range. I know certainly as we look at places where gas is a little bit more expensive, it was quite a bit more painful. And we've also seen that come down a little bit as we've seen some signs of a possible resolution in the Middle East. That pressure has come down and prices have come down, and to even where the most recent print just a couple days ago for inflation was close to about 3.5%. So we're seeing that inflation come down a little bit. And beneath the headline inflation number, core inflation has stayed relatively contained. Shelter costs, or effectively what people pay for housing, is reducing a little bit. Wage growth hasn't accelerated in a way that would signal a broader feedback loop where we see inflation really pick up. So there is still some inflation built into the economy that we want to see get under control, but it's not at concerning levels and it's not at structural levels that would indicate a bigger problem.
That is very good to hear. And question, what do you think that means for the Fed? I know a lot of us were expecting rate cuts, and then all of a sudden it turned to possibly rate hikes, and now possibly rate cuts again. Where do you think we stand, or at least where does the Fed stand now?
The most realistic expectation right now is the Fed keeps things as they are into the second half of the year. If they continue to see encouraging inflation numbers like the really meaningful improvement we saw between July and June, the door may open for cuts, but it's certainly not the near-term expectation. They've been very clear that the controlling inflation is their top priority. And so they'll continue to be watching both unemployment and inflation numbers very, very closely. And I'm pretty confident that we'll see them respond accordingly. If inflation drops, we could see some minor rate cuts. If we do, for some reason, see inflation stay at elevated levels, there is a chance for hikes, but I think that that's becoming less and less likely right now.
Awesome. Well, speaking of rates, let's talk about bonds. I know they're looking a lot more interesting than they were, or at least they have been for a while.
Yeah, absolutely. They're more appealing than they've been for quite some time because rates are higher than they've been in at least recent history. If you think back to about 2020, 2021, and into 2022, interest rates were near 0%. So you really weren't getting paid to own bonds versus, say, a money market fund. That picture has changed really meaningfully. Now you can get quite a bit more income by being in that core bond holding versus in cash. And so we think it's a really thoughtful time and a really appealing time to say if we're holding excess cash just for safety as part of our portfolio, now is a great time to put it to work. We'd like to be buying bonds right now because we think that rates are more likely over the next few years to come down versus go up. And so that's a good time to be buying bonds.
Well, speaking of portfolio changes, midterm elections are coming up this fall, and clients have been reading headlines to expect a lot of volatility. Since in the past, in midterm election years, we have seen quite a bit of volatility. So what are your thoughts, and do you think that there are truth to those headlines?
Yeah, I think that's a really good question. And when we look at the numbers and the chart here, we can see that there is a meaningful increase in volatility, particularly in the few months leading up to midterm elections. So right now we're into July. If we look at July, August, September, and October, midterm years versus all other years, there's a really meaningful difference in the amount of volatility we see. And so that idea of more volatility is grounded in real historical data, but it's also really important to note that that doesn't really impact long-term returns. So there's going to be a lot of political noise around midterms, but history is consistent that it doesn't really matter from a market perspective which party holds power. What the market is really concerned about is uncertainty. We don't know who's going to be in power, but then once we have certainty on that, we tend to see markets perform very well regardless of who's in charge. I think the biggest variable here we're going to see is the conflict in the Middle East. Whether or not there's a lasting peace agreement there is going to be very impactful on what we see in energy prices. And energy prices kind of feed their way through the rest of the economy. High energy prices for longer periods of time makes everybody's costs go up, which drives prices up. And then we're talking about inflation again.
Well, even with all the uncertainty that we possibly have coming up, what do you think we have in store for the second half of the year? And what do you think that people should be doing to prepare in their portfolios?
Yeah, absolutely. I think that the idea of being prepared for volatility, but continuing to be optimistic about the long term is the best approach here. And so that means we need to stay disciplined. We need to stay diversified. We need to stay anchored to our long-term plan rather than what we see in short-term headlines. The most important things that we're going to be keeping an eye on from a portfolio and an economic perspective through the back half of the year, inflation data, right? Are we going to see that continue to come down, or, potentially is this Middle East wild card going to drive energy prices and inflation up? Keeping an eye on midterm noise and making sure that we're well positioned to ride that out. And then, of course, as we look at the bigger picture, what we see for earnings and AI investment throughout the rest of the year is going to be very meaningful. From a really practical portfolio perspective for our clients, we generally recommend keeping 18 to 24 months of expected portfolio withdrawals in cash or cash equivalents, which gives you enough to ride out that market volatility without selling at the wrong time. We look back to like a 2007, 2008 type major prolonged bear market. That 24 months of cash is going to give you the ability to not have to sell into that really ugly market, but it's also not keeping so much cash that you're losing away purchasing power to inflation versus the rest of your portfolio. So I always say, if it's been a little while since we've looked at that together and kind of right-size that number, really good reason for us to connect and have a conversation.
And Charlie, that is a great final message. And we are going to wrap up now. So thank you again for covering all of this. And as always, to our clients and people watching, if you have any questions on anything that we've talked about today or anything else you'd like to discuss, please don't hesitate to reach out to us. And thanks again. Thanks, Charlie.
Yeah, thanks, everybody. Thanks, Casey.